Hi, I'm Sheila, and we're having a look at audit risk and risk of material misstatement questions that appear in ACCA's AAA. This video will show you how to answer these questions, focusing especially on writing out the answers. Audit risk and ROMM questions are very important because they appear in question 1, which are actually big mark questions for the ACCA's AAA paper. There are so many issues given in an audit risk ROMM scenario, but this video will specifically focus on inventory. Now, it's common that when students see inventory in exam scenarios, they go on to an autopilot mode, and this is what the answer usually looks like. That IS2 requires inventory to be stated at the lower of cost and net realizable value and risk that inventory is overstated. Now, whilst indeed it is true that IS2 does require inventory to be valued at the lower of cost and net realizable value, it may be incorrect to put this down in your answer, especially when you have not taken any regard for the facts given in the scenario. If you do not take into account the facts in this scenario, then it's very unlikely that you're going to be able to get full marks for your comments on inventory. There are so many aspects of inventory that can actually appear in your question 1. You could have a situation of obsolete inventory, slow-moving inventory, damage or faulty inventory, discontinued lines of inventory, inventory located at multiple locations, continuous counts, inventory valued using standard cost, inventory valued at selling price less margins, which is what happens in a supermarket, right? So the way you write out your answer for each aspect is going to be different. So what we're going to do now is we're going to have a look at some AAA past year questions and see how we can answer them. So we're going to start off with a question called Oak. So you may have already done this question before. It's a brilliant question. It's got some analytical procedures inside here. And I've just given the excerpt of this question. It's not the full thing. Remember, what we're doing is we're just focusing on inventory. So the question says, evaluate audit risk. So let's go up here and have a look at the scenario. It says, you are an audit manager in Maple responsible for the audit of Oak, a listed company. Now, normally what happens is in audit risk questions, we are immediately going to take into consideration the fact that it is a listed company, because there would be risks appearing from that. But here, we're just focusing on inventory just for this time round. Then the question goes on to say, Oak manufactures electrical appliances such as televisions and radios. And that's a very important point to note. The fact that they are a manufacturer means that they've got a factory, but of course, we're not looking at that for this particular video. When you're thinking about a factory, we're always thinking about whether there's an impairment of property, but we're not looking at that, okay? We're just looking at inventory. And the inventory in this particular question is electrical appliances. Then it says, which are sold to retail outlets. Now, in the audit paper, it's very important for you to note whether it is sold to or sold through retail outlets. If it's selling through retail outlets, we're talking about consignment inventory. But when you're selling to retail outlets are the receivable then. Okay, but we're not looking at the sales figure here, but just want you to note here, if it's through, we're dealing with consignment inventory. You're aware that during the last year, that means during the last 12 months, Oak lost several customer contracts to overseas competitors, and that's not good news, right? Because you're selling them to retail outlets, and if you lost competition, chances are you're not going to get that back, which means that your inventory is not going to move. However, a new division has been created to sell its products directly to its individual customers via a new website, which was launched on 1 November 2011. Now, this is a December 2011 question, so it's about 2 months before the year end. You're about to commence planning for the audit for the year ending 31 December 2011. So it looks like we're sitting for this particular exam 3 weeks before the year end. Okay, now once you see the year end here, the first thing that you need to do is you need to pay attention to this information here as to whether it is 12 months worth of data in the SOPL, or whether it is less than 12 months. Because it's less than 12 months, we have to gross up the figures if we're going to calculate any ratios that include any figures from the SOFP. So here, the P&L shows only 11 months. Okay, so we've got the revenue, we've got the cost of sales, we've got the GP margin, and here we've got SOFP. And remember, what we're dealing with here is just inventory. We're not looking at any other item within the financial statements. Okay, lots of figures have been given. We can calculate materiality. So how do you calculate materiality? We would take 1,800 divided by the total assets figure of 98,078, and that comes up to 1.8% of total assets, and is therefore material because it's more than 1%. Do you think we can calculate inventory age? I think we can, because if you look at the SOPL here, you have got the cost of sales figures, so we can calculate the inventory age. Why don't you stop the video and see whether you can calculate the inventory age by yourself. Then once you finish, you can switch the video on again. So the figures have been given to you in the question. We have got to calculate the ratios for this year and for last year. All right, but before we calculate the ratios, what we have to do is to gross up the cost of sales. The cost of sales figure has been given to us, 15420, and it is only for 11 months, so we'll have to gross that up, and that comes up to 16822. We've got to do the same on the other side, and that comes up to 17345. So what we need to do now is to calculate the inventory age. So the formula for inventory age is the inventory divided by the cost of sales multiplied by 365. So what is the inventory figure that we have here? We've got 1,800 divided by 16822 multiplied by 365, and we get 39 days. We do the same on the other side. And we can see here that there has been a slight deterioration. Now, a slight deterioration by itself is not going to be much of an issue, but the question does say that they have lost several customer contracts in the last 12 months, and that's not good. Why is it not good? Because of the type of inventory that we have, electrical appliances could actually go into obsolescence. So now that we've done all the groundwork, we've calculated the materiality and we have calculated some ratios. What we have here, the situation is obsolete inventory. So let's see how we can build the answer. The first thing that you'll have to do is to put a mini title there. Then we're going to put down our observation. Observation is information that is from the scenario. Information from the scenario does not earn you any marks except if you have put down any information on analytical procedures. Like here, we said that inventory age has deteriorated. So for every calculation that you put down, you have got half mark here. All right. And then I put down some observations from the question, and that is Oak manufactures electrical appliances, and electrical appliances are subject to technological obsolescence. And the reason why we're worried about that this time around is because they have lost several customer contracts. And if we're going to keep all these items in our inventory, they are very likely going to become more obsolete as the days go by, especially if we cannot find replacement customers. The next thing that we're going to do is put down our comment on materiality. Now, before we have a look at materiality, I just want to point something here, and that is when you put down any kind of analytical procedures, so there has to be some kind of an interpretation of the ratios that you put down. Then we're going to put down our comment on materiality, and the reason why we do this is because when the item is material, it'll be an area of focus, because anything that is material in the financial statements has a potential for a material misstatement inside it. Okay, so that's why we have that there. Then we're going to put down the accounting treatment. So what do you think is the accounting treatment here? Do you think we can put down a comment on that inventory should be stated at the lower of cost and net realizable value? The answer to that is that would be inadequate. You see, if you are talking about obsolete inventory, then your accounting treatment would also be in terms of obsolete inventory. So we're not going to put down, that IAS2 says the inventory is going to be stated at the lower of cost net realizable value. That is not going to be helpful at all. So here we're making a comment as to what IAS2 says that should be done when you've got obsolete inventory. So we're not going to put down this part here. It is really not necessary. It's not going to earn you any marks, so don't put it down there. I'm just telling you that this one is from IAS2. So allowance for obsolete inventory must be recognized as an expense. And what are you going to do with that? You're going to include that as part of cost of sales in the period in which the allowance is made. So put down the accounting treatment. So what do we have so far? We've got the observation from the scenario, you've got the materiality, and you've got the accounting treatment. So what's the next thing that you do? The next step is to state that there is a risk that the allowance for obsolete inventory is not made. So the risk here is not that inventory is overstated. That would be the impact on the financial statements. Here, we're specifically talking about the risk. So let's have a look at this again. The accounting treatment is allowance must be made. The risk here is that it is not made. And consequently, inventory may be overstated. So when you say consequently here, we're looking at the impact on the financial statements itself. So how does the marking scheme work? The examiner says for the accounting treatment would be 1 mark, and for the risk would be 1 mark, and for the impact on the financial statements would be 1 mark. So you have got 4 marks here. All right, but just to point something out here on the area of materiality, sometimes there is a cap on the marks given, and it would depend on the examiner. Now let's have a look at another question called DALI. All right, remember we're focusing only on the area of inventory and nothing else. So at the bottom here, the requirement of the question says evaluate the audit risk. This is only an excerpt, okay? So it says you're responsible for the audit of DALI, a listed company. Normally, we would pick that up. As usual, it's very important to know what kind of business that your client is in. Here, they're manufacturing equipment and machinery for use in the quarrying industry. So that would be your inventory. You're planning the audit of the financial statements for the year ending 31 December 2015. And the projected financial statements for the year recognize a revenue figure, profit before tax, and total assets of so much. Now, the reason why we note some of these figures is because it would help us to calculate materiality. And if we're dealing with inventory, the important figure here would be total assets. The question says, machines and equipment made by DALI are mostly made to order in the company's 3 manufacturing sites. So we've got a very important point down here, and that is the machines and equipment made by DALI are mostly made to order. So what does that mean? These are bespoke machinery having a special design according to customer requirements. Where management considers that the design work will be significant, the customer is required to pay a 30% payment in advance. Now, if we're doing the whole question, we will definitely take that into consideration. And the risk here is that they recognize that as revenue. Okay, but we're not looking at that. We're only having a look at inventory. So the remaining 70% is paid on delivery of the machine to the customer. Typically, a machine takes 3 months to build, and a smaller piece of equipment takes an average 6 weeks. And what that means is that you're going to have lots of WIP at the year end. The design and manufacture of bespoke machinery involving payments in advance has increased in the year. And what that means is that your WIP would probably also increase. DALI also manufactures a range of generic products which are offered to sale to all customers, including drills, conveyors, and crushing equipment. These are all general items, okay? But it's still inventory, no doubt. So let's just note that with a slightly different color. According to the most recent management accounts, which are available at 30th November 2015, what was the year end here? 31 December 2015. Remember, you're sitting for this exam 3 weeks before the year end. So if that's the case, then here they've given us an excerpt of the SOPL. We need to have a look at this to see whether it is 12-month figures or not. And this one is already projected to 12 months, so we don't have to worry. And they've given you inventory days here. They've already calculated that, so no mark will be given for your calculation. All right, they've already calculated it, but you can use it in your answer. According to the most recent management accounts, which are available at 30th November, WIP is valued at 12 million. So you can calculate materiality for that. And the majority of these orders will not be complete until after the year end, which means that WIP is going to be pretty huge. In recent weeks, several customers have returned equipment due to faults, and Dali offers a warranty to guarantee that defective items will be replaced free of charge. So items have been returned. So that's not good. So if you look at this particular question here, how many items of inventory do we have? We actually have got 3. What are the 3? WIP, the generic products here, which is probably linked to this figure down here, where the age is actually increased, and you have got faulty items. So how on earth are we going to write it out? So the first thing I'm going to say here is that the machines and equipment made by Dali are mostly made to order to customer-specific needs, and a majority of these orders will not be complete until after the year. And this is the observation. So there's no analytical procedures here, means that you're not going to get any marks. So keep it very, very short. The reason why we put down the observation is to help us to move into the accounting treatment part of things. So what would the accounting treatment be on? It will be on the WIP. All right. So the next thing we're going to do is we're going to put down the point on materiality. So WIP of 12 million represents 13.3% of total assets and is material. The next would be the accounting treatment. So why don't you stop the video for a minute and see whether you can write out the accounting treatment. Your observation in this particular question is that we have got bespoke WIP. Therefore, when you put down your accounting treatment, it has to be WIP related as well. So we're saying that WIP must be valued according to the stage of completion. All right. Now, what would be the risk? See whether you can try and write it down by yourself. So stop the video, write it down, and then check back. So we're back here. So what is the risk down here? The risk down here is that you have got bespoke WIP. Each one is in accordance to a particular customer needs. So identifying the stage of completion is probably going to be a little bit more challenging. So the risk here is that it might be difficult or challenging, not impossible, but difficult to ascertain the stage of completion for each item in progress, as many of the machines and equipment are of unique design. You've got to remember that your number of orders have got to have increased over the year, and therefore it will be a little tedious going through each machine one by one to make sure that you've identified the correct stage of completion. So then what would be the impact on the financial statements? So the impact on the financial statements would be that consequently WIP will be misstated. So on the observation, how many marks you get? Nothing. On the area of materiality, assuming that you're still within the maximum materiality marks given, you've got 1 mark. You've got the accounting treatment as being 1 here. It's fairly simple, but please take note that we're not saying that inventory has got to be stated at the lower of cost in NRV. We're not saying that. We're making it very, very specific to WIP. So what would be the risk? That it would be challenging. Risk would be 1 mark, and the impact on the financial statements would also be 1 mark. What will happen if you said that the risk that WIP may be misstated? You'll still get this 1 mark, but you would not have gotten this mark because you did not put down the actual risk. Let's go on to the next item of inventory. We have faulty inventory. So I put the title down there, and I put a little bit of observation in saying that in recent weeks, several customers have returned equipment due to faults. We've already done the materiality calculation here, so we're going to go straight to the accounting treatment. So what would be the accounting treatment? Now the question here is, would you be able to sell faulty inventory? No, you won't be able to. So then you're going to say here that faulty inventory is no longer saleable and must be written down to its net realizable value. In this particular case, NRV would probably be 0. So what we're saying is that we want to write it off, unless of course there is some kind of a scrap value. All right. So remember, you don't have to put down the IAS reference. No marks are given for that, so you can leave that out. So observation, accounting treatment, and the next thing would be risk. So what would be the risk, do you think? See whether you can write it out by yourself, the risk and the impact on the financial statements, and then turn the video on again. So we're going to say that risk, that the faulty inventory is not written down to its NRV. Consequently, the inventory is going to be overstated. So how would the marks be here? One mark for the accounting treatment. So we're saying that it must be written down, must be recognized as an expense, and included as part of the cost of sales. We're making sure the answer is complete. Then we've got the risk down here, and then we've also got the impact on the financial statements. And the last item that we're going to deal with in this particular question, Dali, would be the generic equipment. So this information has already been given in the exam question, therefore you're not going to get any marks for that. But the point to note here is that the inventory age shows that the item is more difficult to sell. Now, because we're dealing with equipment, quarrying equipment, it's not as if it's going to become obsolete or anything like that, but we would have to make an allowance for slow-moving inventory. Allowance for slow-moving inventory must be recognized as an expense. So when you're putting down the accounting treatment, it's a good idea to use these kinds of words like they must be. It tells you the actual accounting treatment. You don't have to put the reference down here. We're saying that it's included as part of cost of sales and it will be treated as an expense. All right. And then risk here, that the allowance for slow-moving inventory has not been made. Accounting treatment is that it should be made. Risk is that it has not been made. And then consequently, inventory is going to be overstated. So we've got 1 mark here for the accounting treatment, 1 mark here for the risk, and 1 mark for the consequences as well. So let's go on to the next question. So we're going to read this question. It's an ROMM question, and then I want you to stop the video and to think about how you are actually going to write out the answer. To write out the answer, you need to identify what is the issue here. Is it slow-moving inventory? Is it a continuous count? Is it obsolete inventory? So you need to think about that. So let's go and read the scenario. It says, Grohl is a company which produces circuit boards which are sold to manufacturers of electrical equipment such as computers and mobile phone. So this is their inventory. What are they producing? Circuit boards. One of the key materials used in production is copper wiring, which is imported. Now, if we're doing the full question here, we'd definitely pick that point up, and we're going to talk about foreign purchases and foreign payables. But we're not looking at that here. We're just looking at the topic of inventory. As a cost-cutting measure during the year, a contract with a new supplier was signed, and all the company's copper wiring is now supplied under this contract. The question says, soon after, a number of customers had returned claiming faults in the circuit board supplied. On inspection, it was found that the copper used in the circuit boards were corroded and therefore unsuitable for use. The corrosion is difficult to spot as it cannot be identified by eye and relies on electrical testing. So, what item are we dealing with here? We're dealing with faulty circuit boards. Remember, the question tells you that these circuit boards were returned, and that means these circuit boards would be in the warehouse probably at the year end and included as part of the good inventory. So what do you think is the accounting treatment for faulty circuit boards? Do you think we'll be able to resell it? I don't think so, because it says here that the copper used in the circuit boards was corroded and unsuitable for use. I don't think we'll be able to sell it. I don't know whether we'll be able to sell it as scrap. That's possible. So how are we going to write it out? You could stop the video for a few minutes, maybe a couple of minutes, see whether they can write out the full answer, where we're looking at the observation. There's no materiality here. There's no analytical procedures here. Go to the accounting treatment, do the risk, and do the impact on the financial statements. All right, we're back. So I'll give you my answer and you can compare it with your answer and mark it. So here I've got inventory faulty circuit board. So instead of putting down the observation, I'm just using that as part of my title. Fine, because there's no marks given for observation anyway. So I'm putting down the point here that the faulty inventory is not saleable and must be written down to its net realizable value. And we're saying here, we're dealing with corroded copper. So we're saying the NRV would be 0 unless there is some kind of a scrap value. All right. And then we're saying that the NRV must be recognized as an expense and included in the cost of sales. So make sure that when you're writing down the accounting treatment here, we're saying what should be done, recognized as an expense, where does the expense go, part of cost of sales. And then we've got the risk that the faulty inventory has not been written down to its NRV. Consequently, inventory could be overstated. So we've got 1 mark here, 1 mark here, and 1 mark here for the accounting treatment. Let's try out another question. So we've got Laurel Group. You may have tried this question out before. Remember, we're only having a look at inventory. Evaluate the risks of material misstatement. We're only looking at inventory, so it really doesn't matter whether it's ROMM or it's audit risk. You're a manager and you're responsible for the audit of the Laurel Group with a financial year ending of 31 May 2017. And this question is a March 2001 question. So the year end is not yet over. So if it's not yet over, then it's very important for you to go and see whether the SOPL projected to be 12 months or not. If not, we've got to gross it up, just like we did in the oak question. The group produces cosmetics and beauty products sold under various brand names. So we've got the product here. So what are they? They are a manufacturer. They've got cosmetic and beauty products. And under various brand names, which are globally recognized and which are sold in more than 100 countries. In December 2016, 6 months before the year end, the Chico brand name was determined to be impaired by 30 million due to allegations that made in the press and by customers that some ingredients used in the Chico perfume range can cause skin irritations and more serious health problems, and the Chico products have been withdrawn from sale. What do we have here? We have inventory. So I'm not going to talk about inventory in general. We're going to talk about the Chico inventory. If it has been withdrawn from sale, what kind of an issue is this? It's a faulty product, isn't it? It's been taken out, so you've got to write the whole thing off. Previously, we said it could be 0 or the scrap value, but if you're talking about perfume here, the Chico brand perfume range, I don't think you'll be able to sell it for scrap value, so you probably have to write it off to 0. So here in the question, when we go down here, let's have a look at inventory. Whoops, inventory is not available. So what do we have here? We've got current assets. So we're going to make use of that to calculate materiality. And materiality will be calculated against the total asset of this particular question. If we had inventory, we'd be able to calculate the materiality of inventory. But for now, we're just going to calculate the materiality in relation to current assets. So why don't you take a couple of minutes and see whether you can write that out. So we're back here. And we're starting off with a little bit of an observation. Keep it really short because there are no marks given for this particular comment here. All right, so we're saying that Chico products have been withdrawn from sale as it was found to cause serious harm. The inventory might still be in current assets. Put down the materiality. Here we're looking at the current assets as a whole. All right, current assets as a whole is material. Then we're looking at the Chico inventory itself. And we're saying that it's not saleable, therefore write the whole thing off. We're not going to look at scrap value. It doesn't make sense. And then the risk that it has not been written down to its net realizable value. The net realizable value in this particular question would probably be 0. All All right. And consequently, inventory may be overstated. So you've got marks for the materiality, the accounting treatment, and the risk, and that the inventory is overstated. So it's really quite simple, isn't it? Let's go on to the next question and see what it's like. Remember, we're only focusing on inventory. So it says here you're a manager and you're responsible for the audit of Adams, a listed entity. And the company has got a year end of 30th September. Ross, Lynott, and Beard are all wholly owned, acquired subsidiaries which manufacture different textiles. So since we're talking about inventory, this is your inventory here. Ross, one of the subsidiaries, manufactures luxury silk clothing with almost all of its output sold through approximately 200 department stores. So what do you think? Let's go and read further. SOFP recognizes assets of 21.5 million. So they're giving you the assets of Ross because they want you to calculate to see whether it's a significant component or not, but we're not looking at that since we're only looking at inventory. And it says any silk clothing which has not been sold within 12 months is transferred to Lynott, where silk material is recycled in its manufacturing. Okay, so we're just looking at the main item here. Let's go to that line again. Ross manufactures luxury silk clothing. Is that cheap items or expensive items? Expensive items, which means that the inventory at the year end could be material. But the thing here is that it says that the inventory is sold through department stores and not sold to. So if you're selling it through, then you are dealing with consignment inventory here and consignment sales. So if it's consignment sales, it cannot be recognized. If it's consignment inventory, then whatever inventory that we have at the 200 department stores must be recognized as Adams inventory and not the department store's inventory. But if the question said that the output was sold to the department stores, then that would be an outright sale. So how would you write out the answer for consignment inventory? So I'm going to start off with my title, and then I'm going to put on a little bit of an observation, the story, emphasizing that the items were sold through the stores. Then we've got the consignment inventory. So I'm putting down the accounting treatment here, and that the consignment inventory should be included as part of Ross's year-end inventory. And of course, that will go into the consolidated financial statements as well. And then they should be valued at the lower of cost and net realizable value, and that would be 1 mark. Then the risk here is that the inventory at the department stores are not included. Consequently, the inventory may be understated. So watch out for this word when you're dealing with exam questions. Let's try another question. Ted, June 2015, it says you've just been assigned to the audit of Ted, a new audit client of your firm, which a financial year end of 31 May. Now, if we're looking at audit risk as a whole, definitely the new audit client would be picked up. But remember, we're only focused on inventory for this video. Ted is a newly listed company. We would normally pick that up as well. But again, this is only on inventory. Is a computer games designer and developer. This is their inventory. Has grown rapidly in the last few years. The software used in the computer games is developed in the country, but the manufacture of the physical product takes place overseas. Then it says computer games are largely sold through retail outlets. So what I'd like you to do is to stop the video for a few minutes and write down whatever you want to write down for inventory, then turn the video back on again and see how you have performed. So now that you've already done the work, let's see what the answer might look like. So the first item they're going to look at is the fact that you've got inventory overseas. Remember, they are manufactured overseas? I'm going to put down a little bit of an observation. Remember, there are no marks here, so keep it really brief. Okay, then go on to the accounting treatment. The components and finished goods at the overseas location should be included. You can always use the word should, must, as part of TED's year-end inventory and valued at the lower of cost and net realizable value. Risk here is that they have not included it inside. Consequently, inventory may be understated. There's another type of risk here, and that is detection risk. This is an audit risk question, so you can actually bring in the detection risk portion. If this question was an ROMM question, then you would not be able to bring in the detection risk portion, okay? But we can also say here, because it's overseas, the audit team may not be able to attend the inventory count overseas. Consequently, it may not be possible for us to obtain sufficient appropriate audit evidence regarding completeness and existence of inventory held overseas. So these are some of the things that you can actually put down. So mark your answer and see how you performed. My answers are very simple. They're very short. They are short, but they're complete. And you've got to remember that there is a time frame in the exam that you have to meet. So you don't have all the time in the world to get the job done. So take that into consideration as well. So there's another item here, and that is the computer games are largely sold through retail outlets. So how would you write the answer here? It would be on the area of consignment inventory, just like what we did just now. Okay, so how would the marks be worked out? We've already done this earlier with accounting treatment, the risk, and the impact on the financial statements. Risk here is that the inventory at the retail outlets are not included as part of the year-end inventory. Consequently, inventory may be understated. All right, so don't forget that there are separate marks given for risk and the impact on the financial statement. So don't say risk that the inventory may be understated, because if you do that, you're just going to get the one mark and you're going to lose out on the other mark. So remember that we've got a pair down here. So let's go on to the next question, the last one. So we're going to read this question called Island, and then you need to decide what is the issue here. Remember, we're still dealing with inventory, but there's so many different kinds of issues with inventory. All right. So the question says, evaluate audit risk. It is now 1 July 20X5, and it says Island is a manufacturer of machinery used in the coal extraction industry. So manufacturer, machinery. So that's your inventory here. Island designs, constructs, and installs machinery for its customers. Generally, it takes about 6 months from the order being finalized until the final installation. So that means that we're talking about WIP here. And the question also says that WIP is valued at 8.5 million. And then it says inventory count was held on 15th May 20X5. The chief engineer estimated the stage of completion at each machine as at that date. The question gives us some figures so that we can calculate materiality. Can you take 2 minutes to write out your answer, and then I'll give you mine, and then we can compare. So your 2 minutes is up. Let's have a look. We've got the observation. Remember, there are no marks for the observation, but the point down here is that the observation is important because that would help you to further develop your answer. The point down here is that the count was held 2 weeks before the year end, and therefore there will be no count at the year end. So after the observation, we go on to materiality, which we've done. Then we've got the accounting treatment. The accounting treatment is for WIP. And it must be valued according to the stage of completion. But the thing here is that the physical count or the ascertaining of the stage of completion was done 2 weeks before the year end. And therefore, the risk here is that we're not sure whether the stage of completion can actually be correctly rolled forward to the year end position. Can you see that? The risk here is that it will not be rolled forward. That the figure that we've got, the 8.5 million of WIP, it could be different by the time you reach the year end. So have a look at the marks here. The materiality would be 1, the accounting treatment here would be 1, the risk would be 1. So consequently, WIP may be misstated, especially if they do not roll it forward correctly. All right, so we've actually done 7 questions here, but let's go and have a look at the different aspects that can be examined when inventory is involved. So when it started off, we're saying that we're focusing on how to write out the answers. We're focused on inventory. We're saying this kind of an answer here, just to put down inventory, states that the lower of cost and net realizable value is not going to earn you very many marks. Then when you look at risk that inventory is overstated alone, then you forget about the fact that separate marks are given for the risk and separate marks are given for the impact. And we also said that it was important to respond to the facts in the scenario. And there's so many different aspects of inventory. And this is important for you to note because the way you write the accounting treatment would be different for each one of them. So let's very quickly summarize how you're going to write out the answer. How do you start? We're going to start off with the observation. A little bit of a story, or you can also put down the title up there. All right. Then we're going to go on to the materiality. Then we're going to look at the accounting treatment. And when you put down the accounting treatment, if you say the allowance needs to be made, please specify where is the expense going to be charged to, and is it going to be in the cost of sales or something. Make sure that you finish off the accounting treatment correctly. Don't leave it hanging halfway. Then we're going to look at the risk, and then we're going to look at the impact of the accounting trade, the impact of the risk itself on the financial statement item, in this particular case, inventory. So this is very easy for you to follow. We have got an O here, we've got the M here, A, R, and we've got the I. So that would be the exam technique that we're going to use to develop audit risk answers. So it doesn't matter whether you're talking about deferred tax or share-based payment expense or whatever other item. If you follow OMARI, you should be able to get your full marks. Taking into consideration, materiality is 1 mark, accounting treatment would be 1 mark, the risk would be 1 mark, and the impact would be 1 mark. All right, so we're done with that.